Okay, so we will be going over chapter one, which is basic insurance concepts. So these are just words that you need to become familiar with, understand more than anything the definition of it, as you may see this on the test and just want to simplify it for it to become as easy and as simple as possible. Okay, so first off is insurance. So what is insurance? When you purchase insurance, so when you purchase insurance, what you are doing is you are transferring the risk from yourself to the insurance company. Okay. And that's with any type of insurance. If you think auto insurance, when you purchase auto insurance, you're transferring the risk from being in a car accident and having to pay to fix the car to Geico. Life insurance, you're transferring the risk from you to Primerica. In case a person passes away, Primerica is taking on the risk of paying out $250,000, the death benefit. So insurance is the transfer of risk from an individual to an insurance company, an insurer. Okay. And purchasing insurance is one of the most common ways to transfer risk. And we'll cover that at the end of this chapter. But once again, insurance is the transfer of risk. Next is the term indemnity. So indemnity means to return, to restore, or to reimburse. So another word for indemnity is the term reimbursement. So when you're going to reimburse or you're going to be reimbursed for something, it's bringing it back to its original value. So, for example, let's say you have auto insurance and your total coverage is $50,000. Person gets into a car accident, they take their car to the body shop starts to work on it. The total cost of repairs was $30,000. Now, yes, you're covered for up to 50, but the cost of the repairs was 30. So the insurance company is only going to restore or reimburse the body shop up to whatever the original value was of the damages, which would be in this case $30,000. So indemnity, another word for it, reimbursement. Okay. And when we get to chapter four, we'll see this word again as it comes into play as one of the writers. Okay. But it's to restore itself to its original value. Now, one more point to make on the word indemnity is that it will never pay out more. It will never pay out a penny more or a penny less than what the cost was, what the original value was. Next is risk. So the term risk, by definition, it is the uncertainty or possibility of a financial loss, of a loss occurring. Now, on the test, they're going to talk about two different types of risk. The first risk is what is known as pure risk. So pure risk is where there will be a loss only, meaning death in the sense of life insurance, right? Pure risk is where there will be a loss only. The second type of risk is what is known as speculative risk. Now, speculative risk is where there will be either loss or gain, meaning there can be a loss of money or there can be a gain of money. An example of that would be gambling or playing the lottery. Now, one thing to remember also about these two different types of risk is that pure risk is the only type of risk companies will insure. So companies will not insure speculative risk. Companies will only insure pure risk. Okay. So you may see a test on the question that asks what type of risk is insurable or what type of risk would create an insurable event. And the correct answer would be pure risk. Speculative risk is not insurable. Okay, so speculative risk is not insurable. So companies will not insure speculative risks. Now, next is the term the law of large numbers. So, what the law of large numbers states, it says to have predictable loss, insurance is based on a large number of similar exposure units. So, in order for a company to have more predictable loss, meaning they can determine what a loss may be or what it may cost, the number of exposure units must be bigger, must be larger. So, for example, let's say a 24-year-old male is going to apply for insurance, right? So 24-year-old male is applying for insurance. Now, the insurance company is not going to go look at just a group of five 24-year-old males. Why? Because if they look at this group of five 24-year-old males, they might see that number one, number two, number three, and number four are unhealthy. And just one of those five is actually healthy. So that means that four out of five 24-year-old males are unhealthy, which would not be an accurate prediction. So what the law of large numbers states is that they just want to look at a bigger number. For example, they want to go look at 100,000 24-year-old males because from those 100,000, they'll see. So they will look at 100,000 24-year-old males, and from that 100,000, they'll see that 90,000 of them are healthy and 10,000 of them are unhealthy. So there, basically, it's stating that 9 out of 10 24-year-old males are healthy. This batch of five was just maybe a small batch of this 10,000. So to have predictable loss, the number must become larger. And that's what the law of large numbers states. Next term is adverse selection. So adverse selection, if you see the word selection there, just replace it or think of the word selective. So when you're selective, another word for that would be you're picky. Okay, you want to pick and choose. So insurance companies, what they do is they have this term called adverse selection, where they want to be picky with who they're going to insure. So it says the tendency of people with higher than average risk are going to look to buy insurance more than healthier people. So what that means is that people that already have possible health issues, that are older, they're going to look for insurance more than someone that is younger and healthy. Why? Because they may see some complications coming along. So adverse selection just states that a company wants to be picky with who they're going to insure. Just because they get 100 applications from people between the age of 50 and 60, that does not mean that they're going to approve all 100 people. They're going to be picky with insuring the most healthy, but also some that are semi-healthy, but not everyone. So once again, they want to be picky, right? They want to be selective with who they're going to insure. So this also ties into a term called profitable distribution of exposure. And what this profitable distribution of exposure is, if you just move the words around, it means that the company is going to distribute their exposure so that they are profitable. Okay. So they're going to distribute their exposure so that they are profitable. So what that entails with a profitable distribution of exposure is it is when poor risk, meaning unhealthy people, are on one side and the super healthy are on the other side. So this is how a company is going to distribute their exposure so that they're profitable. So what that means is that poor risk will be on one side, super unhealthy. Preferred risk will be on the other side, which means super healthy. And then average risk is going to be in the middle of that. So that's how companies distribute the exposure so that they're profitable. They're going to say, we're going to put the super healthy on this side, we're going to put the unhealthy on this side, and we're going to keep everyone that's average in the middle. And that's how this adverse selection takes place, where they're going to be picky. They want to focus on ensuring people that are at the tip of average going towards super healthy preferred risk, right? They don't want to really look at poor risk because they want to make sure that they're profitable. Now, next is exposure. So loss exposure. So it says situations that present the possibility of loss. So what does that mean? Is the more you expose yourself to something, the higher the possibility of a loss that happens. So for example, is exposing yourself more to a loss. So in insurance, the older you are or any health issues that you may have, your exposure to loss becomes higher. So, one thing I want you guys to remember about loss exposure is the higher the exposure, the higher the rate. So, the higher the exposure, the higher the rate. What does that mean? Is the older you are, the higher the rate for insurance is going to be for you, meaning it's going to be more expensive, right? So the higher the exposure, the higher the rate. Okay. So the more exposed you are to the sun, the more higher the probability you'll get sunburned, right? If you're not wearing sunscreen. Okay. Just to help simplify it a little bit. Next is the term peril. So peril is another word for the cause of a loss. So peril, another word for it is the cause of loss. So an example there on the test, I've seen the question that pops up that refers to a tornado. So a tornado that tore down a house. What was the cause? In other words, what is a tornado considered? Well, the tornado is considered the peril because it was the cause of the house being torn down. Okay, so peril, another word for cause. Now, next are hazards. So hazards, by definition, they are an event, a condition, or a situation that may increase the likelihood of a loss occurring. For example, let's say it's pouring rain outside and you can't see 5 feet in front of you. That is a condition that can increase the likelihood of there being a car accident and a loss occurring, meaning people pass away. Let's say there's a car pulled over in the middle of the freeway, 4 a.m., it's pitch black, there's no lights on, no emergency lights on. That's a situation that can increase the likelihood of a loss occurring. Okay, so that is what is known as a hazard. Now, on the test or on the exam, yes, they're going to refer to four different types of hazards. The first is what is known as a physical hazard. So a physical hazard is anything to do with you physically that can increase the likelihood of a loss occurring. An example of that would be blindness or being deaf. Let's say you're blind, you're walking down the street, you're crossing the street, a car is coming, a car thinks you see it. Obviously, the person is blind, so the person does not see the car coming. Car hits the blind person passes away. Now there's a loss. That would be an example of a physical hazard. Number two is a moral hazard. So a moral hazard is a lie on an application. So for example, someone applied for life insurance previously and they were just not honest on the application. They would be considered a moral hazard. Why? Because they were not truthful on an application previously for insurance. So they are considered a moral hazard. Number three is a morale hazard. So morale with an E at the end. An example of this would be driving recklessly. So a morale hazard is driving recklessly. In other words, it is carelessness. And this you might see on the test. Carelessness is what is a morale hazard. For example, you have multiple speeding tickets that you've got that the individual's gotten in the last year, and they still speed. So a company would consider them a morale hazard. Why? Because they're just careless. And the fourth is what is known as a legal hazard. So a legal hazard is using clients' money for personal use. Another term for that would be commingling funds. So this typically doesn't happen today because everything's done electronically, but back few decades ago, agents would actually show up to a client's home and they'd pick up cash or check for their insurance payment. And what the agent would do would send that payment in to the insurance company. Now, what they would do sometimes is they would deposit that money into their bank account, right? Or that check into their bank account and they would pay it from there, which that is what a legal hazard is where you're commingling funds. You're taking a client's money and you're mixing it with your money. Not that you're necessarily using it, but you're putting it together, okay, in a same account. That is not okay to do. So that would be considered a legal hazard. All right, next we have insurable interest. So insurable interest, if you just flip the words, is you have an interest in insuring that person. So for example, by definition, insurable interest is the policy owner must have the possibility of losing money upon the death of the insured. So the policy owner must have the possibility of losing money upon the death of the insured. Now remember, majority of the time the policy owner and the insured are the same person. But there's other times where it is not the same person. This is where insurable interest must exist. So, for example, is there insurable interest in me putting life insurance on myself? Absolutely. Why? Because if I pass away, I don't want to leave my family a financial burden. I can put life insurance on my wife, on my mom. Is there insurable interest there? Absolutely. Why? Because if they were to pass away, I'm financially responsible for taking care of whatever needs to be taken care of. I can put life insurance on a business partner. Let's say I own a restaurant and I have a business partner with 50-50 partners. I can put life insurance on him. He can put life insurance on me. Key person or key employee insurance is also there's insurable interest there. That would be an example of, let's say I own a restaurant. I put life insurance on my chef because he's the one that knows how to make the food, right? He keeps people coming back because they know the food's always going to taste great. So I can put life insurance on him. Why? Because he's valuable to my business. So there's insurable interest there. Now, where there will not be insurable interest, so there also will be insurable interest on the creditor having insurable interest on the debtor. Meaning, if you take out a loan at Bank of America is the creditor, they can have insurable interest on you, the debtor, meaning so that they make sure that they get their money back. Okay. But there will never be insurable interest the other way around. And on the test, you might see that question. It'll say something like, all of the following are examples of insurable interest except. So we're looking for which one is false. Then it'll say on insure a policy owner's own life, on a spouse, on a business partner, or on a debtor on a creditor. There will never be insurable interest between a debtor on the creditor. Okay, it's always the other way around. The creditor has insurable interest on the debtor. And lastly, here is that with insurable interest, it must exist at the time of the application and there must be consent. Meaning, I cannot put life insurance on my mom just because she's my mom. Yes, there's insurable interest, but she also has to give consent, meaning she's aware and she's signing that it's okay for me to insure her. Okay. Now, next, a term is utmost good faith. So, utmost good faith, it says when you rely on the representations of the other. So, we'll cover what a representation is in the next chapter, but it's just, in other words, a statement that is believed to be true. Okay, so putting that in there, it's when you rely on the statements that are believed to be true of the other party. Just in a nutshell, to simplify it, it's just that both parties are honest. So the insured is being honest with the insurer, and the insurer is being honest with the insured, right? But keyword there, rely. They're relying on what the other party is saying. Now, lastly, are the methods of handling risk. So these are five different ways on how an individual can handle risk. Acronym for that is STAR with two R's. Easy way to remember it. So the S in STAR, the first one is sharing. So when you're sharing risk, is you're spreading it between business partners. So let's say we own a restaurant together. You're paying 50% of the insurance. I'm paying the other 50%. We're spreading the risk, right? We're sharing the risk. So we're going half and half on it. The second one, the T is transfer. So when you transfer insurance or you transfer risk, remember right at the very beginning, insurance, what is insurance? Insurance is when you transfer the risk from you to the insurance company. So it's exactly that, is you passing responsibilities of risk to the other party, which the other party in this case would be the insurer. Okay. And one thing as well to note is that transfer is the most common way to transfer risk. Sorry, to handle risk. Okay. So transferring the risk, buying life insurance is the most common way to handle risk. Now, the A is avoidance. So avoidance is you just not choosing to do something. On the test, there's a question that I've seen that pops up where it talks about a gentleman who was in a car accident and now to work, he walks or he takes the bus. What type of risk management technique is this? And it would be avoidance. He's avoiding driving so he doesn't get into another car accident. Okay, so avoidance. And then the first R is reduction. So reduction is lessening the possibilities of loss. So example there would be installing an alarm system at home. There's also a question that refers to this, and it says the individual installs a dead bolt lock, right? So individual installs a deadbolt lock at home. What type of method of handling risk is this? Reduction. He's reducing the chances of someone breaking into his home. And lastly is retention. So retention, it says taking responsibility for loss. So another word for retention is think of the word retain. So when you think of retain, retain in other words means to hold on to. Okay. So when you're holding on to something, you're holding on to some of the risk. So for example, here there is a question that I've seen that pops up that will say, so all of the following are examples of risk management, of risk retention, except. So there's going to be three of them that states that you're holding on to some of the risk, and one of them is stating that you don't. So it will say A, deductible, B, copayment, C, self-insurance, or D, premium. Okay. And the correct answer there would be premium. Why? Because you're not holding onto some risk when you're paying your premium. Your premium is the payment that you make for your insurance. So think with auto insurance, you pay your monthly premium, but then if the individual gets in a car accident, you take your car to the body shop, you still have to pay the deductible. So you're holding on to some of the risk because money's going to come out of your pocket. Co-payment, same thing. You have health insurance, you pay your premium every month, you go see the doctor, then you have to pay the 10, 20, $30 co-payment. So you're still holding on to some risk. And then C, self-insurance. Self-insurance just means that you have enough money that you do not need life insurance, right? You have, $15 million in a bank account. So if anything were to happen, your family would be okay, right? Self-insured, you don't need any type of insurance. So the correct answer, remember, is D, because premium is the payment that you're making for the insurance. It's not you holding on to some of the risk of the insurance. Okay. So that is all of chapter one. So hope you guys just make sure review this as many times as possible and try to simplify it as much as I could. But if you have questions, please feel free to ask.